A very good afternoon to you all, friends. I am Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board and Chairman, Sustainability Reporting Standard Board. On behalf of my board, my own behalf, and my Vice Chairman, CA Vishal Doshi ji in absentia, I welcome you all to this 83rd program of the AASB for this council year. And today's topic is Audit Considerations in Audit of Financial Instruments. And we have a very young and dynamic technical speaker, CA Achal Jain with me. Achal Jain has a very vast experience of working on Ind AS as well as doing audits of large listed companies. And Achal has contributed extensively to the initiatives of AASB and also the initiative of the Financial Reporting Review Board of the ICAI. Friends, this year ICAI has taken the auditing standard learning to the doorstep of every member. And in this endeavor, we've been organizing very regular programs on various topics. So far, we have covered all auditing standards. We have covered CARO in Schedule 3. We have covered each item of the financial statement, and now we are covering the special aspects. This year, we have also organized an expert panel whereby our members can ask their queries pertaining to auditing matters while doing audit of corporates as well as non-corporates. 50 such experts are available for this purpose. The service is free of cost and is available up to 30th of September 2022. Kindly make the maximum use of this. And I wish you all a very happy learning. And with this, I would request my friend and technical speaker for the day, C. Achal Jain. I would like to thank him for sparing his invaluable time and would request him to kindly start his technical deliberation. And we are waiting for our council colleague, C. Abhay Chajadji, as a keynote speaker. He is in a meeting, and as and when he comes, we'll invite him for this keynote address. Thank you, and over to you, Achal.
Thank you so much, Sanjeev sir, and thanks everyone for being in this session. And as sir just mentioned, today's topic is audit considerations around the financial instruments. I would say, in a way, today we are going to touch upon two very important aspects. One is on the financial instruments, wherein bit of technicalities involved in terms of the accounting aspects. Secondly, when it comes to the audit, so because from the accounting perspective, this topic is considered to be very important and times technical also. So that's why audit consideration also becomes very, very important. And we are going to discuss both of these aspects as we move forward. So beginning with the understanding of the financial instruments, let's talk about financial instruments briefly in terms of how they are covered by the accounting standards. So currently, if we look at the framework which is available in terms of the accounting guidance for financial instruments, there are three standards which cover this: Ind AS 109, Ind AS 32, and Ind AS 107, wherein we have a separate accounting standard altogether, which is dealing with the disclosure requirements in relation to the financial instruments, and that is Ind AS 107. And if we have to really talk about the financial instruments, in a way, we can also say that approximately 50 to 60% part of the financial statements is nothing but the financial instruments only. Yeah, that is actually true. And as we'll move further, we'll also get into detailed understanding as to why this becomes a significant component, or we can say becomes a major proportion of the financial statements in a way. Now, let us try to understand about the financial instruments. Now, what is a financial instrument? Financial instrument is actually a contract which gives the right to receive cash or which creates an obligation to pay cash. In simple terms, we can say this. Yeah, and I'm not getting into too much accounting guidance today because that is not really our perspective in terms of our discussion. So now talking about the financial instruments, we can say financial instruments can be broadly categorized into three parts. One is the financial assets, second is the financial liabilities, and third is the equity. Okay, so I'm just breaking down this into three parts. Now, let's talk about financial assets first of all. Now, what is a financial asset? Financial asset has to be an asset to start with. Means, in respect of all the assets which are available in the financial statements, as an auditor, we need to first of all check whether the asset is financial or not. In case it's a financial asset, it will fall under the purview of these three accounting standards, wherein we'll have to just go through those accounting guidances when we are auditing any of these financial assets. And in case it's not a financial asset, then it is called as non-financial asset, wherein these three accounting standards will not apply. Okay, let's take some examples of financial assets and let's also try to understand in brief as to what can be a financial asset. In very simple terms, as we understand about financial assets, we can say if there is a contract which gives the right to collect cash or any other financial asset, that becomes a financial asset. Now let's take some examples around it as to what can be a financial asset. If we talk about trade receivables, means debtors. Now in respect of a debtor, can we say that there will be a contract? The answer is yes. There has to be an arrangement. And through that contract, will the receiver get a right to receive cash? The answer is yes. That's why debtor or trade receivable, what do we call it as? Financial asset. Let's take another example for this. Security deposit. Now, in respect of a security deposit, let's suppose this security deposit has been given for in case of a rent arrangement. Okay. Now, in such a case, do we have a contract in place? The answer is yes. We have a contract in place. Now, through this contract, do we receive the right to receive cash? The answer is yes. Yes, there is a right to receive cash. Now, in such a scenario, because there is a right to receive cash, what does this instrument become? This instrument also becomes financial asset. Just give me 1 minute. When we talk about non-financial asset, so we discussed about financial assets. Now let's talk about non-financial assets. Now, any asset which will not be a financial asset, very simply, what will it become? Non-financial asset. Okay. So let's consider some examples of non-financial assets. Say if we talk about property, plant and equipment. Now, in case of property, plant and equipment, do we have a contractual right to receive cash? The answer is no. So that's why what would it become? Non-financial asset, right? Payable in respect of GST, or we can say, let's suppose if we have some GST input credit, is that an asset? Answer is yes. Now we need to assess whether this asset will be a financial or non-financial. Now in this case, what do we need to check? Do we have a contract in place? The answer is no, because in respect of GST input, there's no contract in place. Yeah, it is something which comes from the requirements of statute. It is something which is statutory in nature. It is not driven by a contract. So that's why it will not fall under the purview of financial asset. And that's why, where would it go? It would go to non-financial asset, right? Now, We've just tried to touch upon some of the aspects related to financial assets and as to what will not be a financial asset. So as an auditor, let's try to get on to the considerations as to what should be the first consideration. Now, whenever we start with in respect of audit of the financial statements, what's the first thing that we need to look at? Of course, the trial balance. And if we look at the trial balance, we understand now that trial balance should have all the assets broken into two categories: financial and non-financial. That's the first step for us to begin with. And for this trial balance to have two types of assets, whether it is about any asset. So each and every asset has to be broken into these two categories. Now, whether the management has done this or not, how do we take care of this? It's about the audit of chart of accounts of the company or the entity. Therein we'll get to understand as to whether the classification of an asset, or we can say segregation of an asset into financial or non-financial has been done correctly or not. And this is extremely important. Let's try to understand why. See, if we talk about financial asset today, their accounting guidance is available under standards on financial instruments, and which is quite different from the accounting guidance which is available for non-financial instrument. The standard which deals with property, plant and equipment is India 16. So the recognition criteria, the measurement criteria, yeah, or the disclosures around those assets are different from what we see in case of a trade receivable, because the recognition and measurement criteria is significantly different from what is required to be done in case of non-financial. Okay, so that's why at the first stage, now we can understand why it is very, very important for us to do this audit of segregation in a very appropriate manner, and which is generally overlooked. Generally, we don't get into too much details around it. Generally, we focus only on the face of the balance sheet, wherein we just try to assess whether this classification of the financial assets or the non-financial asset looks okay or not. But till the time we don't go deep into the breakup of all of these financial assets or all of these assets into financial and non-financial through the trial balance or through the chart of accounts, there are chances that some of the assets may not have been classified appropriately. Okay, so that's why it's the first step which an auditor needs to look into. Now, I'll just try to link financial liabilities with the same understanding which we just obtained for financial assets. So let's just quickly touch upon the financial liabilities. We are not done with our accounting or the audit considerations for financial assets. We'll go back to that aspect also. Now, the way an asset is required to be segregated into financial and non-financial, similarly, every liability is required to be segregated into financial and non-financial when it comes to the audit of the financial statements. It's the accounting that we need to check. Now, as around the classification of a liability, whether it's financial or non-financial, we'll just again go by the same understanding. What is a financial liability? If there is a contractual obligation on the part of the issuer to pay cash, then the instrument will become financial liability. Now here again, if we take some examples, we can say borrowings. What is borrowing? Borrowing is nothing but a financial liability. Why? Because there is a contract, and this contract creates an obligation to pay cash. Similarly, if we talk about trade payable, there again, what do we have? We have a contract, and this contract creates an obligation to pay cash. Okay. Now, if we have to look at some examples of non-financial liability, so there again, we can just look at some similar sort of examples. If we talk about GST liability, if we talk about income tax liability. Now, do we have any contract in place in respect of these liabilities? The answer is no. The answer is no. So that's why, what would these liabilities become? these liabilities would therefore become non-financial liabilities. Okay, so now the next step, or we can say something which we need to again check in respect of all the liabilities, is the segregation of liabilities into financial and non-financial. And there again, if the segregation is not done appropriately, then the recognition criteria which the management may have considered in respect of financial or non-financial could be different. Yeah, so that's the first step we need to assess. Okay, now as we move further, let's come back to this understanding of financial assets or the financial instruments. Generally, when we talk about financial instruments, some of the things which come to our mind is about the complex instruments. So generally, we have an understanding that if we are talking about financial instruments, it has to be something which is a very complex instrument, which is not the case, as we have just discussed. Because if we talk about debtor, that is nothing but a financial asset and therefore a financial instrument. If we talk about creditor, that is nothing but a financial liability and therefore a financial instrument, because any financial asset liability will become a financial instrument. So that's why when it comes to the audit, so now in terms of audit considerations, when we talk about, we are not only required to limit ourselves to the accounting guidances which are available under, say, Ind AS 109 or Ind AS 32 or say Ind AS 107. We need to go beyond this. And therein, I would just like to touch upon first aspect, and that is by taking a very simple example of debtor. Okay. Now, if we were to audit debtor, I'm sure there are certain procedures which everyone will know that these are the audit procedures which every auditor would want to apply in respect of audit of debtors. But let's generally seen missing when it comes to audit of debtors. I'm just taking this as an example. Now, first of all, to begin with, as an auditor, what do we need to check? Whether the debtors have been recognized as per Ind AS 109 or not. And let's now quickly sort of, briefly discuss as to what are the requirements of 109 or Ind AS 109 in respect of accounting of debtors. Now, for any financial asset, Ind AS 109 requires this financial asset to be classified. Okay, so it's the classification, or we can say it's the bucketing. And there are three buckets which Ind AS 109 provides. First is the amortized cost, and second is the fair value. Under fair value, we have two categories: fair value through OCI, fair value through P&L. Yeah. So this is something we need to look at. Just give me 1 minute. Just give me 1 minute. All right, I understand there was some network issue and that's why we had this interruption. Okay, now when it comes to classification, now for this classification of the financial asset into three categories, Ind AS 109 provides the guidance. For any financial asset, first of all, what do we need to check? We need to check the business model of the entity. As to what's the business model of the entity. If the business model of the entity is to hold the instrument to collect cash, okay, to hold the instrument to collect cash, and The second aspect is that this collection or the contractual cash flows that we receive from that instrument meets the SPPI criteria. What is SPPI? Solely payment of principal and or interest. Means if the contractual cash flows that we receive are limited to only these two, principal and or interest, and nothing beyond this. And for interest, it has to be something which is driven by the borrowings requirements, or you can say something which has to meet the criteria of interest as per any borrowing arrangement. Okay. In such a case, if both these conditions get fulfilled, means entity's model is to hold the instrument to collect cash, and the contractual cash flow that we receive will meet the criteria of SPPI, then the financial asset will get classified under amortized cost. And I hope that everyone understands this. Yeah. Everyone understands this. So that's the aspect that we are considering. तो आई थिंक चल जाना चाहिए. Hi, sorry for this interruption. All right, so now moving on to the next classification. So let's suppose if along with this business model to hold the instrument to collect cash plus meeting the SPPI criteria, entity is also selling the financial assets. Entity is also selling the financial assets. Therein, the classification which this financial asset will get will be fair value through OCI. Okay, so now let's take some examples for these two. In the first category, when we talk about amortized cost, which example will fit in debtor? Because in respect of debtor, will there be the business model to hold to collect? The answer is yes, borne under amortized cost. And when the debtor is collected, is it really limited to principal and or interest? The answer is again yes. Okay. Now, if along with this entity in its portfolio, say for example, if we talk about asset management companies, they don't only have the financial assets wherein they hold the financial asset to collect cash, they also keep selling those financial assets. So it's a mixed model which they follow. Therein, those financial assets will become what? They will get classified under fair value through OCI. Okay. Next category or the next classification is fair value through P&L. In a way, we can say those financial assets which will not fall under amortized cost or fair value through OCI will by default go to fair value through P&L. So they will go to fair value through P&L. Okay. But we can also assess as to what's the criteria for fair value through P&L. In simple terms, we can say if the entity is selling the financial assets or the business model of the entity is only to sell the financial assets, in such a case, what will happen? That financial asset will fall under fair value through P&L. Okay, yeah. Now, if an asset is classified under amortized cost bucket, the accounting or the recognition or the measurement criteria which has to be applied is amortized cost. I'm not really getting into the accounting literature in detail because I understand all of us know about it. So that's why we are just moving on to the audit considerations around it. And when it comes to those financial assets which get bucketed under fair value through OCI or fair value through P&L, what's the recognition? Sorry, what's the measurement criteria for them? Fair value. So they are measured at fair value. The changes in the fair value keep going to OCI in case of fair value through OCI bucket, and they keep going to P&L in case of fair value through P&L bucket. Yeah, so that's the understanding that we obtain in respect of these three buckets which are available. Now, let's come back to the audit considerations. So now as an auditor, what do we do? So as a first step, as an auditor, we classified, or we can say we audited the classification of all the assets into financial and non-financial. The next step is in respect of financial assets. All these financial assets need to be classified into three buckets. As an auditor, now we need to check whether this classification is done appropriately or not. Because we have discussed that the measurement of the financial assets changes depending on the classification which is there for each type of financial asset. So that's something which is important for an auditor to look at. And if we talk about debtor, so now debtor, as we discussed, let's suppose if it falls under amortized cost. So when it comes to the chart of accounts, the classification is something we have looked at, and then we look at its measurement, whether it's been done appropriately, means it's been measured at amortized cost or not. Okay. Now, this is something which Ind AS 109 will require us as an auditor to audit the debtor. But are we really limited to this aspect of audit of this type of financial asset? The answer is no. So let's now touch upon some of the other audit procedures which will also be required to be followed in respect of debtors. Now, in respect of debtors, a very important audit procedure which is required to be followed happens to be the rolling out of, or we can say obtaining independent confirmations. Okay, now there is a separate auditing standard which deals with the guidance around it. And in respect of this auditing aspect of obtaining the balance confirmations independently, let's try to understand as to what will be the various steps which are going to be involved in this. When it comes to the debtors, we understand that we need to obtain a third party evidence. Why? Because how will a debtor get generated? By making sales. So that means for debtor, what evidence will the company always have? A sales invoice. Through the sales invoice, we can check whether the debtor is recognized appropriately or not. But we all understand that external evidence is considered to be more conclusive, more reliable as compared to internal evidence. Correct? Yeah. So that's why when it comes to obtaining the external evidence in respect of debtors, what is it that we obtain? External confirmations. Therein, out of the debtors, we need to select a sample. Okay, we need to select a sample of some of the debtors which will fall under that sampling criteria. And for the debtors which are selected, we are required to obtain independent confirmations from those debtors. So what's the first step which the auditor will do? Auditor will discuss these parties, these customers with the management, that this is something which the auditor plans to do, means plans to obtain the independent confirmation. Yeah, once this is done, once this is discussed, auditor will roll out letters to those customers and will request them to confirm the outstanding balances in respect of the client or in respect of the entity to the auditor independently. Means this balance confirmation statement which the customer will send will not be sent to the company, will not be sent to the client. Instead, this will be sent to the auditor directly. Now, as we discussed that before rolling out the confirmations, auditor will also have discussions with the management. It doesn't mean that the management will have say in terms of selecting as to which all debtors are required to be considered for obtaining the balance confirmations. No, that's not the idea. That's not the intent over here. The only thing which is intended over here is to just make sure that we make communication with the management before reaching out to the customers of the management. Yeah. Secondly, administratively, to a certain extent, management is also required to be involved in this process. Yeah. So though the management will not intervene in a way by obtaining the confirmations at their premises or by them, but in case some of the debtors don't respond, management will also be required to request those customers to respond to the auditor. Now, it may happen that some of the debtors respond to the auditor, and when they respond to the auditor, the balance which they confirm may not be matching with the balance which is outstanding in the books of the client. In such a case, what will be required to be done? Management will have to provide the reconciliation for the same, and auditor will be required to check that reconciliation. So it's not something that the audit of debtors gets completed if we obtain the balance confirmation. No, till the time that balance is not really reconciled, we can't really say that the balance is correct or not. So if the reconciliation is done, that's been verified, that's been checked by the auditor, then it is okay. Now there will also be certain customers who may not respond at all. They may not revert to the auditor. Now, as a next step, auditor is required to send reminders to those customers. Second reminder, third reminder, at least these reminders auditor will send to those customers. And once the reminders are sent, if still the balance is not confirmed by the customer, then in such a scenario, in respect of those customers who have not responded, auditor will be required to perform some alternate procedures. And what are going to be those alternate procedures? One, of course, will be to check whether the balance which was outstanding as at the reporting date, whether that has been collected up to the date of audit or not. So say for example, if we are auditing 31st March 2022, we are, let's suppose, on 23rd September 2022, and we plan to wind up everything say by 25th of September 2022, then auditor will pick up a cutoff date. So let's suppose 23rd September is the cutoff date. So up to this date, auditor will ensure as to whether the balances are collected or not. In case the balances are collected, it's good. In case the balances are not corrected, there are still some balances which are outstanding in respect of the debtors. In such a case, auditor will also be required to verify the invoices, means the build-up of this debtor, which is outstanding as at the reporting year. And how do we, as an auditor, verify the build-up? By verifying the invoices, by verifying the contracts in respect of those customers. Now, herein, one point becomes very, very important, and let's try to understand. Because Here again, many a times mistakes are seen happening. See, when we started with the debtors in terms of our audit, in terms of rolling out confirmations, did we select all the debtors for the audit purposes? Answer is no. We looked at the total population, but out of the total population, we selected a sample on which we started performing this procedure. So let's suppose there were 100 debtors, out of which 25 were selected by the auditor. Okay. So now we need to understand that we as an auditor are working on an audit sample. We are not working on the population. Okay. So 25 is what? It's a sample in place. Now let's suppose out of 25 debtors, 20 have responded, which have also been reconciled, and auditor has performed that work. But 5 have not responded, means auditor didn't receive any balance confirmation independently from. What is it that the auditor now wants to check? The built up of the debtors. Okay. And let's suppose for these 5 customers, auditor will be required to check if at all invoices are required to be verified. For these 5 customers itself, 60 invoices will have to be checked by the auditor, because as many as 60 invoices have been issued through which this built up has come in place. Now, in such a case, can the auditor say that out of these 60, I'll only select 30, I'll only select say 20, or I'll only select 40? Means can the auditor further become selective in terms of audit of this audit, or you can say performing alternate procedures on these 5 customers? The answer is no. Answer is no. Why? Because sampling cannot be done on the sample. Sampling has already been done. Whatever sample is there, that sample needs to be tested 100%. Otherwise, what will happen? We'll just keep applying sampling on the sample, which will not be appropriate. Okay, which will not be appropriate. So that's why it's very, very important to understand this perspective, because many times, as I've told you, this aspect is ignored. And generally, we tend to pick up samples in respect of samples, and wherein the audit procedure in a way goes wrong. All right. Now, if we talk about this audit procedure, I'm sure most of us understand that this procedure is considered to be extremely important procedures. One of the extremely important procedures when it comes to the audit of the debtors. Now, I'll also touch upon another sort of accounting requirement as well as the audit consideration, which comes in respect of the debtors. Just give me 1 minute. I understand there's some network issue again. Just give me 1 minute. Hi, so I'm just hoping that the network should not be any problem anymore, and sorry for this interruption. Okay, so now talking about another consideration, particularly in respect of debtors, which becomes very, very important, is about the provisioning requirement. And we all have to deal with this provisioning requirement in respect of almost every, in respect of, I would say each and every client. Now, when it comes to the provisioning requirement, therein, we now need to understand that Ind AS 109 provides a detailed guidance in the form of ECL, expected credit loss model, which is required to be followed. And I'll just briefly touch upon this ECL model because this is more about accounting. This is significantly different from what we do in case of Indian GAAP. Because in case of Indian GAAP, what do we do? In case of Indian GAAP, we follow incurred loss model. And what is incurred loss model? Incurred loss model means once the loss is incurred, that is when we create the provision. Okay, means if we believe the debtor has gone bad, we create a provision for this. Okay, means we are waiting for this loss to happen, and once the loss is there, we create the provision. But Ind AS 109 doesn't allow us to wait till the time loss is incurred. I'm saying it doesn't allow means there's something which has to be done as per Ind AS 109. And it requires the management to create an expectation in respect of the bad debtors, or we can say in respect of credit risk, or we can say in respect of time value of money. So broadly, these are the two aspects one has to look into in terms of creating an expectation for the loss in respect of debtors. And let's understand how this will be done. See, if we talk about a debtor which has been generated today, and if this debtor becomes 1 year old, and if we see that after a debtor becomes 1 year old, in the past, let's suppose in the past 5 years, what do we see? That all the debtors which are 1 year old, generally 5% is the default on them. Okay, so I'm just taking this average amount. I'm not just taking this on an individual basis for the purposes of our discussion. Debtor has got generated. We should create an expectation in respect of all of these customers as to what is their credit risk. Okay, and depending on the credit risk which they will have, we need to create a provision in respect of those debtors today itself. And one may think as to why this provision is required to be created so early. The answer is that all of these debtors which become bad, okay, or in respect of which we create some provision, say 6 months later or 1 year later, they were always new at some point of time. Yeah. Generally, what we see in case of banks or NBFCs, yeah, therein this RBA requires the provisioning to be followed. Yeah, so we can just say in a way that concept is also required to be applied here. So we are not looking at any standard percentage which is required to be applied the way it is done over there. No, in this case, this percentage is required to be assessed by the management on the basis of buckets. So we can say debtors which are 0 to 30 days old, which are 30 to 60 days, which are 60 to 90 days, and then we have 90 to 180, 180 to 360, more than 365, or say 365 to 2 years, and then more than 2 years. So this is the bucket which the management is required to create, and depending on the bucket, management needs to check historically say in the last 5 years and the last 3 years, as to historically what is the percentage of default depending on the risk customer, depending on the credit risk of the customer, as to what is the risk involved in respect of those debtors, and accordingly create a provision for them. Now, when we talk about this provisioning requirement, we are not really looking at only the historical pattern. Standard says we also need to be forward looking. Let's understand how. Say it may happen that a debtor in the past 3 years has not defaulted, and that's why if we go by the historical pattern, we may say that there's no need to create a provision for this debtor. But if we are forward looking and if we look at the present scenario, what do we see? That in the past 3 years, the credit risk of this debtor was not so bad or was not really bad. But now the credit risk of this debtor has been deteriorating significantly period on period. And that's why, even though in the past years we have not really seen default in respect of this type of debtor or say these categories of debtors, there are chances that this debtor or these types of debtors may default in future. And that's why we need to be forward looking. Yeah, so we can't really go by the historical pattern. We also need to be forward looking. Okay, and same goes with the case wherein in the past we may have seen that debtors has been defaulting, but we may see a significant improvement in terms of their ratings, in terms of the credit risk of the debtor, and basis which we may not want to create so much provision, which otherwise would be done if we only look at the historical pattern. Okay. Now, all of these aspects are very, very important for the auditor to apply, because we will also have to understand one point, that when it comes to the provisioning or when it comes to the application of this ECL, it's all about estimates. Yeah, because there's no fixed formula which the standard is giving you. Standard is only giving you the guidance, and therefore a lot of judgment is also required to be applied. Yeah. So the moment we get into the estimates, therein the professional experience and the judgment of the auditor also gets involved. And that's why auditor need to be that extra careful, because it's all about audit of estimates. Yeah, which is very, very important for the auditor to look into. Another thing which is required to be considered in respect of ECL particularly happens to be the consideration of time value of money. Now, generally, we don't consider this aspect, but this is something which the standard requires us to consider. And let's understand as to how this may have an impact on the provisioning requirement. Say, for example, if we talk about a party to whom the credit which we allow is 60 days. Okay, credit that we allow to this party is 60 days. There is another party to which credit allowed is 90 days. And there are certain parties to which credit allows is 30 days. Okay, so we can see that the company has been allowing credit of say 30 days, 60 days, 90 days to various customers. But what do we see? That despite giving this credit period, certain customers, even though they are not defaulting in any payment, they are paying the full amount, they are not making the payment on time. Means within the due period, they are not making the payment. Maybe the customer who has got 30 days credit period is making the payment after 90 days. Maybe the customer who has got 90 days credit period is making the payment say after 120 days. Okay. Now in such a scenario, let's try to understand as to what is happening. In such a scenario, what is happening? In this scenario, the company is losing out on time value of money, isn't it? Because the money which is not collected on time So that's why this is additional aspect which the management needs to consider when they get into the ECL assessment in respect of trade receivables. And that is something which the auditor is also required to take consideration of. Otherwise, what will happen? Otherwise, some of the provision amount may go wrong. Yeah. And here, I think one important aspect which is generally overlooked and which at times management doesn't really want to consider happens to be the provisioning matrix. Management generally picks up the customers and assesses them and checks whether the customer is collectible or not. Wherever they believe that the amount is not going to be collected, management will be okay to create a provision. Now we need to understand that this is something which used to happen under Indian GAAP. Okay, and which is something which I called as incurred loss model, which is not really the case under Ind AS. Yeah, so that aspect one has to consider, that cannot really be ignored. That is very, very important for the auditors to look into. All right. Yeah. Okay. Now, this is something which I talked only about, I would say, one of the financial assets that we have. Let's talk about another financial asset, say security deposit. Now, in respect of security deposit, which is given in respect of say lease arrangement. Now, what do we do in respect of a lease arrangement? If a security deposit has been given, and if we have a contract in place, we believe this amount is going to come back to the company. So this security deposit receivable will become a financial asset, wherein we'll apply the guidance of the classification and we'll check whether it will become amortized cost, fair value through OCR, fair value through P&L, and generally this will fall under amortized cost. And if this is falling under amortized cost, so what will happen? The measurement criteria for the security deposit has to be as per amortized cost. Okay, yeah. Now, I would just pick this up, even though it's a very, very simple thing, because still there are gaps in terms of accounting practices when it comes to some of the basic instruments like this. See, for example, if a company has given a security deposit of 1 lakh, in case of a lease arrangement, we generally find that all of these security deposits, etc., are always interest free. Yeah, generally you find them to be interest free. Now, as per the standard, as per Ind AS 109, what do we do? Standard says measure them at fair value at the time of initial recognition, means at present value. So now, if let's suppose the lease period happens to be 3 years, so what is required to be done? We are required to compute the present value of security deposit on today's date and then measure it. And its present value is not going to be 1 lakh for sure. Why? Because this is interest free. So for present value, we'll have to bring in a discount rate. Okay, management will have to bring in a discount rate, basis which they will compute the present value of the security deposit. Correct? Yeah. Now, before I really get into the discussion of the discount rate, let's assume, say, whatever is the discount rate on the basis of which the present value of the security deposit comes out to be 70,000. So it means that at the time of initial recognition, security deposit will be measured at 70,000 and not really 1 lakh, the way it is required under Indian GAAP. And that's why the amount of the security deposit will change, and corresponding to this and the balance amount will go to some other asset. So it will also remain an asset, but this will not really be the security deposit. This is sort of a deferred amount, which is required to be deferred over the period. And as I told you, I am not really getting into too much details around the accounting literature for this. Now, this is something which Ind AS 109 requires and which the management should have done. Now, as an auditor, what do we need to do? We need to make sure that the measurement criteria on the basis of the classification criteria has been applied by the management. It becomes important, because if we don't really get into the detail of the same, if we don't really check that, what will happen? Management may keep recording some of these security deposits at the contractual value. What will be the contractual value? Say 1 lakh, and there will not be any difference. Because of which, what will happen? Because of which the recognition, or we can say the measurement, both will go wrong. They will not really be as per the requirements of Ind AS. Yeah, this is something which the auditor needs to look into. Now we will also talk about the discount rate. See, discount rate is something which has been significantly required by this particular standard at various places. And the determination of the discount rate, or I would say as to what will be the discount rate for the purposes of measurement of various types of instruments, is a very, very challenging task, because you will have to appreciate the fact that depending on the discount rate, the measurement will change, isn't it? Yeah. So if we have 9% discount rate, the measurement will be different. If we have 10% discount rate, the measurement will be different. If we have 8% discount rate, measurement will be different. Yeah. So if the management may want to manipulate the numbers, what can they really do? They can manipulate, or they can just, make the changes or use this discount rate for manipulation of this numbers. And this is something which the auditor will have to look into. This assessment of discount rate, whether that has been done appropriately or not, the documentation around it, because discount rate is not something which the management can just think and apply that for the purposes of accounting requirements. No, there has to be some basis which the management needs to look into, whether it's the IRR or whether it's the cost of capital of the company. Yeah, so whatever basis they have been considering, or whether it's the incremental borrowing rate, so whatever basis they have been considering, what all backups they have obtained, whether they have been talking to their bankers in terms of the borrowing rates they are going to get in respect of the type of instrument which is required to be considered at present value. All of these documentation is something which, and all of these documentation has to be obtained by the auditor. This is something which is extremely important, which can't really be ignored by the auditor. Okay, so this is, I would say, broadly about financial assets that we discussed. Now I'll move on to financial liabilities, and here again I would not really touch upon a very, very complex instrument. Yeah, I'll again keep it very, very simple, but just to remind you that in case of financial liabilities, there are two buckets which are available as against the financial assets. Because in case of financial assets, what do we have? Amortized cost, fair value through OCI, fair value through P&L. But we don't have fair value through OCI in case of financial liabilities. So it has to be either amortized cost or say the fair value through P&L. And here again, standard specifies certain liabilities which will go under fair value through P&L. Okay. For example, contingent consideration in case of a fair value through P&L. Okay. Yeah. Similarly, there are certain other financial liabilities which will go under fair value through P&L, and the standard here says, I'm talking about the accounting standard, that in case a financial liability doesn't fall under fair value through P&L, then we have this residual category of amortized cost. Means all of those financial liabilities will go to amortized cost. Borrowings. Let's suppose a company has taken a loan from a bank. Will it go under fair value through P&L? The answer is no. Therefore, it will go under amortized cost. And in case of amortized cost classification, the measurement which the management is required to follow, the measurement principles which the management is required to apply will be what? Will be that of amortized cost. Here again, what is required to be done? We are required to compute the amortized cost of the borrowing at the time of initial recognition. Okay, and which can again be different from the contractual amount. So if we have to look at the amortized cost, which can be different from the contractual amount, how do we get that? First, if let's suppose management has taken a loan which is not really at the market rate, so there again what will happen? The present value will be different. Yeah, so that will change. In a similar manner, the way we discussed about security deposit scheme. Number two aspect, if we talk about, say, any processing charge, okay, which is generally required to be paid in respect of borrowings. Now, this can have an impact on the total borrowing cost of the entity. Let's try to understand this concept. There is a concept which is called as EIR, effective interest rate. And I'll just keep this very, very simple for the purposes of our discussion as to what is effective interest rate. See, when we go and take a loan, there are two types of costs which are required to be incurred. One is the interest cost, which has to be as per the contract. And second is the upfront fees or the borrowing charges or the processing charges. Correct? So these two costs are required to be incurred in respect of the borrowings that we will have. Okay. So now, standard says that whenever we will have to record the borrowings, we will not be looking at the contractual interest rate. We will be looking at the effective interest rate. And please remember, as to what is going to be the effective interest rate. Effective interest rate means this effective cost or effective borrowing cost in respect of obtaining this borrowing. So if you have taken a loan of say 1 crore on which 10% interest will be paid and say 1% processing fees has been paid. So what is our effective cost? Is it really 10%? The answer is no, it's higher than 10%. And this effective interest rate which is required to be derived. And this borrowing at the time of initial recognition, has to be measured using effective interest rate. Okay, yeah. Now, in this case, as an auditor, what do we need to look at? First of all, whether the effective interest rate which the management has computed is as per the accounting requirements or not, whether that has been done appropriately or not, wherein we'll have to get into the documentation of the borrowings, means the borrowing agreement, the processing fees of which the bankers would have charged, and the sanction letters, etc. Yeah, basis which we'll have to derive some of these things. Now, please also remember that this is very, very important because this is something which we generally don't look into when it comes to Indian GAAP. Because in case of Indian GAAP, what do? This processing fees or this upfront fees that we pay is charged to the P&L initially. But that's not the case when it comes to Ind AS. Under Ind AS, in a way, we are amortizing this processing fee by sort of bringing this total cost as a part of effective interest rate. So therefore, in a way, it is getting amortized over the period of the borrowing, which becomes very, very important for the auditor to look at. Secondly, the amount of the borrowing which would have been derived on the basis of the effective interest rate will also have certain disclosure requirements. Yeah, though it is not really limited to borrowings, it will apply to each and every aspect of the accounting that the financial instruments will require. So these are certain additional considerations for which a detailed guidance is provided by Ind AS 107 as to what are the disclosure requirements for effective interest rate. Yeah, as to how this has been derived, if there's any sort of sensitivity analysis which is required to be given. So all of these disclosures are something which are mandatory in nature and which are generally not really taken care of by the management. So auditor needs to ensure that all of these disclosures are in place when it comes to the financial statements of the company, which is recording any of these financial instruments. All right? Yeah. So I'll now move further on this Ind AS first of all, and through which we'll again try to link some audit procedures around it, and which happens to be a very, very important principle as part of financial instruments, and that is about segregation, or we can say checking as to whether an instrument will become debt or a liability. Okay, something over which Ind AS 32 provides us a detailed guidance. So now please remember that when we will be talking about this debt versus liability, we are not talking about financial assets. Okay, we are talking about something which is required to be paid. Okay, it's something which is a kind of obligation, or wherein the entity is required to give something. And when it comes to this assessment of debt versus equity, it's the issuer's perspective that is required to be looked at. Okay, means who has issued the instrument, not the holder. So let's take an example to understand this. See, for example, a company has issued preference shares. Okay, and those preference shares are redeemable, say after 5 years. Say person X is the one who has subscribed to these preference shares. Now, in this case, who is the holder of the preference shares? That person X. So now we are not discussing about accounting of person X. Why? Because for person X, it's an asset. Okay, it's an asset. So we are not looking at the perspective of person X because he is the holder. Now I'm discussing only the issuer's perspective, means the company. Understood? As to where we are and what is it that we are trying to look into. Now, for this company, which is an issuer, we need to check whether this instrument which the company has issued will become a debt or equity. For debt, we have discussed the understanding, the meaning of financial liability. Anyways, you know about that. Let me just quickly touch upon the understanding of equity as per financial instruments. See, when the entitlement due to a contract requires the issuer, or we can say when the issuer is not obliged to pay cash, when the issuer will not be obliged to pay cash, in such a case, what will happen? In such a case, that instrument will become equity. Let me just bring in some more technicality over here. If by any way issuer can avoid payment of cash, if by any way issuer can avoid payment of cash, then such an instrument will become equity for the issuer. But if by any way issuer will not be able to avoid payment of cash, or say to give a financial asset to the holder, then such an instrument will become financial liability for the issuer. Okay. Now I'll bring in 2-3 examples to first of all understand about this debt as well as equity, and then we'll get on to the considerations as to what all procedures we are required to apply. See, if we talk about redeemable preference share, the company which has issued redeemable preference shares will be required to pay cash to the holder after 5 years. Why? Because they are mandatorily redeemable after 5 years. So in this case, is there any option available to the company to avoid the payment of cash in respect of redeemable preference shares? The answer is no. As per the contract, no. So that's why redeemable preference shares will become what? They will therefore become financial liability, right? Now, let's come on to another example. Say a company has issued compulsorily convertible preference shares, or there's any instrument which will get converted into equity after 5 years. Okay. Now, in this case, issuer understands, as per the contract, issuer will not be required to pay cash if the issuer wants. Okay. In this case, will this instrument become a financial liability? Answer is no, because there is no requirement to pay cash on the part of the issuer. Therefore, in this case, what do we call this instrument as? Equity. Yeah. Now, certain aspects which become extremely important over here. If we talk about preference share, legal nature of the preference share is what? We consider that to be capital. But we have seen that as per this Ind AS, it will not really be capital anymore. It may become financial liability. Similarly, if we talk about debenture, what is the legal form of the debenture? Liability. But if that is compulsorily convertible debenture, will that become a liability? The answer is no, that will become equity. Therefore, we need to understand that as per this standard, we need to look at the substance and not really the legal form of the instrument. Yeah. As an auditor, it becomes very, very important for us to assess whether the instruments which the management has classified and which the management has recognized are really the liabilities or the equities. Because depending on the classification of debt or the equity, the measurement will change. The measurement will change. That's why it's a very, very important consideration on the part of the auditor. This is something which can't really be ignored by the auditor. Okay. Moving further on to this consideration. Now, when it comes to the aspect related to debt versus equity, the accounting guidance for the debt is something which we just discussed for the financial liabilities. Equity is something which is kept at cost. This is not something which is really remeasured. Yeah, the disclosures around these two will also change. So that's why these are additional aspects which the auditor will always have to keep in mind. All right. Yeah. Now, with this, I'll once again pick up, I would say, maybe a couple of financial liabilities to discuss some additional procedures around them. Though may not be those are not really emanating from the requirements of the financial instruments, but this being a financial instrument, what I need to again explain you is that when it comes to a financial instrument, so we are not really saying that each and every audit procedure that will apply is something which is required to be looked at from the accounting guidance. No, there are certain other procedures also which the auditor is required to look at. For example, if we talk about trade payables, and similarly, if we talk about borrowings, and similarly about, say, bank balances. Okay, bank balance is a financial asset. Now, one is their recognition and measurement, which we have seen is something which we need to look at as per the requirements of Ind AS. Second is the audit procedure which requires external evidence to be obtained in respect of these types of instruments. Whether it's about the bank balances, whether it's about the borrowings, whether it's about the trade payables, or whether it's about the trade receivables, something which we just discussed. Okay, and I'm not repeating all of those procedures now because we understand the similar sort of procedures are required to be applied when it comes to obtaining the balance confirmation, whether it is about debtor or whether it is about trade payable or whether it is about borrowings or whether it is about bank balances. Yeah, so I'm not really getting into too much details around it. Once again, it's something we have already discussed, but we need to understand now that all of those procedures are also very, very important. In case of bank balances, will not really be selective the way we have done in case of debtors, wherein we select the symbol. In case of bank balances, we may want to obtain all the independent balance confirmation in respect of all the bank balances that are in place. Similarly, in respect of borrowings, we may want to obtain the balance confirmations in respect of all the borrowings which are in place. Okay. Similarly, if we talk about investments, yeah, so now I'll touch upon the investments. Now, let's try to first of all understand as to what will be an investment and how will this investment be really recognized or measured. Okay. Now, investment, when I'm saying, I'm talking about the investment in equity instruments of any other entity. And if we look at the accounting guidance, if we have investment in equity instrument of another entity, that investment is called as financial asset. Okay. So this is something which is over and above what we discussed in respect of financial assets. We understand that this instrument is what? This is also a financial asset. Okay. Now, in case it's a financial asset, so what do we need to do? Here again, we need to do the classification, whether it should be measured at amortized cost, whether it should be measured at fair value through OCI, or whether it should be measured at fair value through P&L. Now, you may also think through, because I think we have all discussed about this quite a lot, and anyways you understand about the classification requirement. When it comes to investment in equity shares, and irrespective of the business model which the entity may have, we understand that the equity is of such nature which will never allow SPPI criteria to be met. Isn't it? Because the returns which we generate from the equity investments, are they really limited to the interest component? No, they are linked to the market. So that's why to say that the returns which we are generating are similar to what we get in case of borrowing arrangement will be wrong. So that's why in such type of investments, SPPI criteria will not be met. Correct? Yeah. So if the SPPI criteria will not be met, where do we go? Under which bucket do we go? Fair value through P&L. So that's the bucket which we need to look into. Okay. Now, if the bucket is fair value through P&L, we understand how these investments are required to be measured. How do we measure them? Fair value only. And the fair value is something which is required to be remeasured at every reporting date, and the changes in the fair value will keep going to P&L. Okay. So as an auditor, what do we need to check? That all of the investments in the equity instruments of an entity are recorded as per these criteria that we just discussed or not. But in this case, we have some more considerations. Let's try to understand. Ind AS says, in case the company has invested in equity shares and that investment is not held for trading, means the purpose is not to trade into it. That's not held for trading. In such a case, Ind AS gives an option to the entity. We are talking about the company which has invested into equity shares, that instead of bucketing this investment in equity shares under fair value through P&L, it can bucket it under fair value through OCI. So we are saying in a way, it's an option available. It's an option available to the company. So by default, where does it go? Fair value through P&L. But even though it goes under fair value through P&L, there is an option available to the company to move it to fair value through OCI. And this option is something which is irrevocable. What do we mean by irrevocable? Means if the company has brought an instrument under fair value through OCI today at the time of initial recognition, they can't change it to fair value through P&L later. This is something they can't do later. Okay. Now in this scenario, let's try to understand as to what are the audit considerations and as to how do we really check it. First, as an auditor, we will check whether all of these investments are measured, are bucketed as per the requirements of Ind AS or not, number one. Secondly, in case the management has designated, has chosen, has opted to classify certain investments in equity shares into fair value through OCI. So what's the rationale behind this? And are those the one which are not held for trading? Because it should not happen that there are certain investments in equity shares which are held for trading, but those have still been designated over it. And in case those have been designated, is it that the management has been changing it every now and then? Because that is not allowed, because there is something which is irrevocable, right? Yeah. So these are the considerations which the management need to look into, and therefore the auditor needs to take care of that, whether the management has done this or not. This becomes an extremely important procedure on the part of the auditor. Because please try to understand that by changing the classification only, the impact on the P&L goes away. And why would the management want to opt for this classification of fair value through OCI? Because they really want the volatility, okay, in terms of this fair valuation, which may be changing every now and then at the time of reporting date, to be impacting the P&L of the entity. And that's why they may want to do this, and which is something which the Ind AS also allows. But this is something which we need to understand. So there has to be a proper documentation around it. There has to be a proper rationale behind this as to why the management has done this. The important point to note here is that this classification or this designation or this option management can choose on an instrument by instrument basis. So there's not really a policy which the management will have to make, that this is something which is their policy, and basis the policy, every investment which will come in the equity share will always go to fair value through OCI. No, they can choose some of the investments to go to fair value through OCI, and they may keep some of the investments in equity shares into fair value through P&L also. So that's why careful analysis, particularly in case of those companies which are heavily into investments in equity shares, is required to be looked at by the auditor. Another thing which is sort of, I would say, linked to this, and which is also something which is, in a way addressed by another Ind AS also, is about the investment in subsidiaries, associate companies, joint ventures, wherein some other accounting standard provides us the guidance as well as the option to measure these investments at cost. Okay. So that's why now what do we get? We are getting various categories of investments in equity shares. One is this category of investment in equity shares, which is subsidiary, JV, associate, which is required to be taken to P&L. Okay, but because of another accounting standard, this may be measured at cost. Then we have another category of investment in equity shares, which is something which is other than subsidiary, JV, and associate, which is required to be taken to P&L. because the SPI will not be met. Yeah. But in case those are not held for trading, there's an option available to the entity to take them to fair value through OCI. Okay. And accordingly, you can see that because there are various categories of investments which could be in place, and particularly in respect of companies which are making various types of investments in equity shares, yeah, this may become very, very important on the part of the auditor to verify these arrangements. All right. Now, when it comes to the investments in equity shares, we've discussed certain audit procedures which the auditor would want to apply, and which is something which is in line with the accounting guidance. So we are saying that this is the accounting guidance, so therefore auditor needs to ensure that this accounting guidance has been followed by the auditor. Now, as a next step, in respect of these investments in equity shares, or say if there are investments in mutual funds which the company may have done, there again obtaining the balance confirmations in respect of those investment in mutual funds is something which becomes important and something which we generally don't see happening, and that's why it's very, very important to mention it over here. All right. Yeah. So these are some of the considerations which we generally tend to ignore or which are really overlooked. Yeah, but these are very, very important, because tomorrow when it comes to the documentation, or tomorrow when it comes to the review of the audit procedures which are applied, all of these things are considered to be extremely important. So that's why careful consideration of all of these procedures are required to be given. I would also like to just quickly touch upon another type of instrument which has been covered by this accounting standard, financial instruments, and that is about compound financial instruments, and something which is very, very commonly seen, particularly in case of medium size or large size companies. Now, what is a compound financial instrument? Compound financial instrument means an instrument which will have two components, equity as well as debt. And I'm looking at it from issuer's perspective once again. Okay, I'm not looking at it from holder's perspective, because from holder's perspective, there will not be anything which is compound. There will only be always one thing. But from issuer's perspective, an instrument may take two forms. For example, if we talk about compulsorily convertible debentures, okay, debenture will get converted into equity after 3 years, but up to 3 years, interest is required to be paid on the debentures. Now, in this case, if we look at the principal from the issuer's perspective, is this required to be paid? No. Can the issuer avoid payment of this? Yes. So that's why this principal component will become equity. Now, let's come to the interest portion. Is this interest required to be paid by the issuer? Always. Is there any way issuer can avoid payment of interest? Answer is no. So that's why in this case, this interest component will become financial liability. Now, what do we find? That same instrument has got two components, and both these components are required to be recognized separately in the financial statements. And how do we recognize? First of all, the financial liability needs to be recognized out of the total contract amount, and the residual amount will go to the equity portion. Okay. Now, this is something which we call as compound financial instrument. Now, as an auditor, for this assessment of an instrument and for the accounting of this instrument to be looked at properly, it becomes extremely important to go through the underlying document, means the contract which will be in place, to go through that contract carefully. And please remember that some of these guidances that we are talking about, they are not really available under Indian GAAP. So that's why when it comes to the audit under Indian GAAP, we are not really required to look at those clauses of the contract because they will not have any impact on the accounting. But now when it comes to Ind AS, if we ignore those clauses of the contract, what will happen? A compound financial instrument which may be required to be split may not be splitted by the management, and that's why the recognition, the measurement which the management may have done would become wrong. Okay, and of course the disclosures around it will also get impacted. All right, yeah. So I would say this was about the financial instruments, the various types of financial instruments, and the various types of guidances which financial instruments accounting standards provide that we touched upon. But as we discussed, that financial instrument is not really limited to the complex instrument, and at the same time, when it comes to the audit of financial instruments, we are not really required to limit ourselves to the accounting guidance under India's 32 or 109 or 107. It's something which we need to look at beyond this. Yeah. So with this, I would like to just end my discussion over here. And before I really wind up my discussion, I would request, in case we have some questions, any discussions further, happy to have your questions now.
Thank you so much, sir. Thank you so much for detailed and in a very lucid manner, very nice deliberation on the same topic, sir. Thank you so much on behalf of AASB of ICI. Sir, due to the technical glitch, we are unable to receive so many questions. But till time I have tried to fetch the questions, I have received 2 questions. First is,
Sure.
how about partly convertible debentures? Non-convertible part has to be repaid on maturity. For this, there will be no separate document, isn't it?
No, so when it comes to partly convertible debenture, definitely the contract will be one. So there has to be one contract which will define the terms. All of these terms will be defined in that contract. So as an auditor, we need to just go through that contract carefully as to, out of this total amount, what is convertible, what is not convertible, and other than these 2 components, what about interest? Is that at the market rate or not at the market rate? And how is that required to be payable? And accordingly, we need to decide as to what portion will go to the financial liability and what portion will go to equity.
Okay, sir. Okay, sir. So what about investment in the non-convertible debenture of other entity? They will also show an investment in the balance sheet.
See, when it comes to investment in non-convertible debentures, definitely this is also a kind of investment. There's no doubt about it. But the only thing is that the investments that we have discussed for the assessment of whether we take them to P&L or we designate them as fair value through OCI. So non-convertible debentures don't fall into that category.
Okay, sir. Okay, sir. Okay, sir. Right. So these were the 2 questions we have received, sir. Sure. Thank you so much, sir, for sparing your valuable time in spite of your very, very busy schedule as well as some emergencies also. So on behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time and enlightening all of us, sir. Thank you so much, Achal, sir. Thank you so much.
Thanks so much, Anilji, and thanks everyone for sparing your time for this discussion. Thanks so much.
Thank you, sir. Thank you, sir.
Thanks.